and I'll stop in between. We will continue in the next session for that. So yeah, for today's session, my intention was to teach you this ratio analysis. So ratio analysis is also an important component when you are done with creating balance sheet and all the statements related to the company's performance. Now it's time to understand how to make these things more comprehensible when it comes to financial planning of a company. So these sort of big statements with a lot of data generally does not tell a lot of about how the company is performing. So in order to make it more comprehensible, in order to make it more precise, and in order to in order to make justified decisions for the company as to what next to be done, ratio analysis plays an important role. So like before, I'll try to teach you the theoretical aspect of it, and once the theoretical aspects of ratio analysis is done, I'll try to make you understand it using the Excel which we are using. Okay, so we'll start by the definition. Ratio analysis. Ratio analysis is a type of financial statement analysis used to obtain a rapid indication of company's financial performance in the key areas. So it does not have lengthy sort of data in which it is difficult for us to understand and to make judicial decision, but it is like very precise, and this is a very rapid indication, like quick indication of the company's financial performance in various areas. Okay, we can use a ratio analysis to evaluate various aspects of companies' operating and financial performance like efficiency, liquidity, profitability, and solvency. So these things we can easily comprehend if we have done a proper ratio analysis of it. Okay, we'll try to cover these points. So types of ratios, there are precisely 5 types of ratios which we use when we evaluate the performance of a company using ratio analysis. So first is growth, and then comes the profitability, operations, liquidity, and solvency ratio. So growth ratios, profitability ratios, operations ratios, liquidity ratios, and the solvency ratios. Now we have to understand each component in little brief. So I am pretty sure that profitability, liquidity, and solvency, these 3 types of ratios you might have done in your financial management course or some other finance related course, but we will try to understand its theoretical background, and then we will try to implement it using Excel. Okay, so profitability ratio. What is profitability ratio? Profitability ratios are financial metrics that helps us to understand the ability to generate earnings. Okay, this includes profit margin, return on investment, return on equity, dividend payout ratio, and price earning ratios. Okay, so profitability ratio basically एक financial metrics होता है which helps us to know the ability of earning, how much earnings we can generate out of the business we are doing. Okay, so what this includes: profit margin, return on investment, return on assets, return on equity, dividend payout ratio, and price earning ratio. So these ratios comes under the profitability ratio. And now we'll try to understand these specific ratios which are categorized under profitability ratio one by one. So first ratio is profit margin ratio. So the profit margin ratio helps us to know the overall percentage of a profit business makes against its revenue. So revenue is the overall part of a company, the total amount of company generating, and if we'll try to find out the profit out of the total revenue generate, profit margin plays an important role. Okay, So if a company is earning, if its revenue is like 1 lakh, but the profit can be little low from the revenue, because revenue is the total amount received out of the sale made by the company. Okay, so the formula to calculate the profit margin is equals to income from operations divided by total revenue. So this is the basic formula. Income from operations. Operations we discussed yesterday also. Operational activities of a company. Ma'am ka mobile. Just give me a minute. I just. Yeah. So income from operations, if we keep it on the top and if we divide by the total revenue generated by the company, then we can get the profit margin. And the second type of ratio is the return on assets. Return on assets indicates how a business is profitable against its assets. So in profit margin, we are comparing it against the revenue, but in return on assets, we are comparing it against the assets of the company. In simpler word, it determines the efficiency to generate earnings using its assets. Okay, so the formula to calculate, हाँ, तो मतलब ये क्या है कि it shows कि हम अपने assets से कितना revenue generate कर सकते हैं. Okay, so the formula is simple. Return on assets is equals to net income divided by total assets. Okay, so net income we are getting, and we have to divide by the total assets purchased by a company. Moving forward, the third type of the profitability ratio is the return on equity. So similar to return on assets, return to equity is measure that helps us to know the effectiveness of equity in generating profit. तो हमारा equity कितना profit generate कर सकता है? This is what we can calculate using return on equity. The formula to calculate return on equity is as follows. Simple formula है. Return on equity is equals to net income divided by, because इक्विटी हम किस पे देते हैं? शेयर होल्डर्स पे. तो जो शेयर होल्डर्स अमाउंट अपना करते हैं उस पर देते हैं. ओके, सो दिस इज net income divided by average shareholders equity, where average shareholder is equal to shareholder equity is equal to current year equity plus previous year equity divided by 2. इस साल कितना उसको इक्विटी मिल रहा है प्लस लास्ट ईयर हाउ मच इक्विटी ही गेट, वी हैव टू डिवाइड बाय 2, then we can get average shareholder equity, and we have to divide it, we have to keep it as a denominator and put net income as a numerator, so that we can calculate the return on equity, which shows how much profits our equity can generate. And the second last part of it is dividend payout ratio. The dividend payout ratio describes the ratio of dividend paid to the shareholders against the net income of the company. जितना हम dividend pay कर रहे हैं अपने शेयर होल्डर को, उसके अगेंस्ट में देखना है उसको नेट इनकम कितना है कंपनी का. Formula is simple to calculate the dividend payout ratio, which is dividend payout ratio is equals to dividend paid divided by the net income. So these are the hardcore formulas. We'll have to understand them and kind of remember them if you want to dig deeper into it. And then the price earning ratio, that what we call as PE ratio. The price to earnings ratio or PE ratio provides the ratio of earnings per share against the current market price per share. So this is what we call as ratio of earnings per share. तो अभी कितना हमारा शेयर अर्न कर सकता है एज अगेंस्ट द करंट मार्केट प्राइस ऑफ द शेयर. अभी जो मार्केट का प्राइस है वो कितना चल रहा है उस शेयर का. तो फॉर्मूला इज सिंपल, मार्केट वैल्यू पर शेयर डिवाइडेड बाय अर्निंग पर शेयर. कितना हमारा शेयर कर रहा है, अर्न कर पा रहा है शेयर, और उसका मार्केट वैल्यू कितना है पर शेयर का. दिस इज हाउ वी कैलकुलेट द प्राइस अर्निंग रेशियो. सो दिस इज द फर्स्ट टाइप, ग्रोथ. So sorry, profitability we discussed first, and then moving into the growth ratio. So what is growth ratio? Growth ratios are indicators of how fast our business is growing. Simply, by the word you can easily understand. This is these ratios are basically the indicators to show how fast our business is growing. So these growth ratio includes sales growth, income growth, and assets growth. So these the growth of a business cannot be determined by like in some isolation. It needs to have certain parameters to understand the growing potential of a business. So what growth ratios we should consider while calculating the growth ratio are the sales growth, how much our sales is growing as against the last year or the last month, whichever we are taking, and the income growth, how our company's income has growing year on year, and the assets growth, whether our company's assets are growing or decreasing. Okay, so this is what we call as growth ratio. So sales growth क्या होता है? Sales growth is a metric that shows the percentage of increase in sales over a specific period. So it shows us how much percentage of increase in sales has happened with respect to the specified period which we have chosen. Furthermore, it also helps us to comprehend the demand for product services in the near future. So if we understand the percentage of increase in sales over a specified period, now we are in a position to understand how much the demand for our products would be in the coming future, which is uncertain. So if we, this is simple mathematics. Our sale was like 10 units last year, 10 units 2 years back, 15 units last year, 20 units this year. So this is showing an increasing trend by 5. So we can easily predict that our demand for the next year would be 20 as per the as the sales is growing. Okay, the formula to calculate sales growth percentage is as follows. Simply sales growth is equals to current year revenue, जितना हमारा इस साल का revenue आया है, minus previous year revenue. This is the way we calculate the revenue, and we have to divide it by the previous year revenue. So current year revenue would be like 20, for example, and the previous year revenue was 15. So we got 5 and divided by the 5, so is equals to 1. So our sales performance is, sales growth is like 1% increasing. And then the income growth is a metric that shows the percentage of increase in profit compared to the previous year. Simple, sales ki jagah we have to put the income. So it is showing that how much percentage of enhancement has been done in the profit or the incomes a company is getting or generating with respect to the previous year. And furthermore, it also helps us to understand the growth of sales as well as the performance of our product line. So as the demand will increase or as the sales would increase, so it would definitely helps us to grow our sales, and we can easily understand or comprehend the product line's performance, whether our product are being sold in the market or not. So the formula to calculate income growth is as follows. Simple. Income growth is equals to net profit, current net profit minus net profit previous year ka. So we have to subtract net profit for current year minus net profit for the previous year, and we have to divide it by the net profit previous year. So then we can get the income growth in percentage. How much percentage our income has grown over the year or the time we have specified time we have chosen. And asset growth is a metric which that shows the percentage of growth in assets over a specified period. So again, in this we have to understand that how much assets a company has acquired in the current session or in the current financial year. And if we want to understand the percentage growth of the asset, then what we have to do, we have to calculate the asset growth of the company And it also helps to determine the increase in assets of the business, how many new assets a company has acquired with respect to the previous year's acquisition of the assets. And the simple formula to calculate the asset growth is shown below. Assets growth is equals to total asset for current year minus total assets previous year divided by total assets previous year. This is pretty simple. You can easily see my slides and you can comprehend what is going around. Now we have discussed profitability ratio and the growth ratio. Now we are discussing activity ratio. Okay, activity ratios are financial metrics that show the efficiency to leverage its assets to generate revenues and cash. So it shows, it is an indicator, it is a financial indicator which shows that how our assets can be leveraged in order to generate some sort of revenues or cash These includes receivable turnovers, which the companies would receive in coming future, inventory turnover, and the fixed assets turnover. So first one is receivable turnover. What is receivable turnover? The receivables turnover ratio is an accounting metric that quantifies the effectiveness of collecting account receivable. So if a company is receiving accounts, or a company has some sort of accounts receivable, so it quantifies the effectiveness, how effectively a company can receive its accounts receivable actually. So there are certain dormant time in between, so company has to understand how quick or how fast they can convert their account receivable. Thus, a higher receivable turnover indicates the company's efficiency in the timely collection of receivable and also good clientele that pays off debt quickly. Okay, so if the company's receivable turnover is high, it shows that a company can collect its receivables and can generate quick cash out of it. Okay, and then eventually ending up paying its debt fastly, okay, or promptly. So the formula to calculate receivable turnover is as follows. Receivable turnover is equals to revenue the company is generating divided by average accounts receivable, where average accounts receivable is equals to accounts receivable for the current year plus accounts receivable for the previous year. We will have to include add some both of the account receivable, and we have to divide it by the 2 in order to get the receivable turnover. And moving forward, it is like inventory turnover. Inventory turnover is a ratio that shows the number of times a business replaces its inventory during a given period. So what is inventory? You might be quite aware about what is inventory. Inventory is the company's stock we are talking about. So inventory turnover ratio basically help indicate the number of times a business replaces inventory. So how fast the stock has been updated in a warehouse and how fast it is moving to the ultimate consumer. This is what we call as inventory turnover. So how fast our inventory or stocks are being sold into the real market, we can say. In addition to that, it helps a business in making better decisions related to pricing, production, as well as marketing. So if we know how much time our stock is consuming when how much time the stock is consuming when we are trying to sold them into the market. So if we have that idea in our mind, so what we can do, it will definitely helps us making better decisions with related to the pricing. So if we are having a high pricing product and it is not moving at the pace we are wanting it to move, so what we can do, we can reduce its production, for example, okay, or we can reduce the pricing of the product so that it can move out of the stock or inventory as soon as possible. So based on the inventory turnover ratio, we can also make planning for the production. So, if we are producing our goods rapidly or quickly, and we are seeing that our most of the stock uh, are piled up into the warehouse of the company, and they are not moving as we are wanting it to move. So we can hold the production, or we can reduce the production capabilities of the plant in order to make it more smoother. So in that also, inventory turnover definitely helps us to plan our productions as well as marketing to hai. So if our product are not moving forward into the market quickly, what we can do, we can plan certain marketing strategies based on the inventory turnover ratio, based on the time the inventory is taking to actually go to the buyer of the product. Okay, so what is the formula for inventory turnover? So the formula is written here in the bold, you can see it. Inventory turnover is equals to sales divided by the average inventory. So average inventory, if what how to calculate average inventory? Average inventory is equals to inventory for the current year plus inventory for the previous year. We have to add both the inventories, okay, and we have to divide it by 2. Then we can get the average inventory. So we'll have to put the sales on the top, and we have to divide it by the average inventory, and we will definitely get the inventory turnover ratio. This is very important ratio if we are dealing. If I'm talking about the with a company's perspective. Okay, so inventory to is a what we call this. This is the current assets. Now we have to talk about the what is the fixed asset turnover. Okay, so fixed asset turnover is a metric which indicates the ability to effectively generate sales using its fixed asset. So how much a company can generate sales if they want to use their fixed assets. Okay, so thus a higher fixed assets turnover ratio indicates efficient use of its fixed assets in generating sales and vice versa. So if the fixed assets turnover ratio is higher, it is indicating that we are efficiently using our fixed assets in order to generate sales. So if the ratio, if the if fixed asset ratio is like lower, or it's not up to the mark, so it is typically showing us that the that our fixed assets are not generating enough sales. Okay. So now here is the formula written in the board. You can see the formula to calculate the fixed assets turnover. So fixed assets turnover is equals to total revenue generated by a company divided by the total fixed asset. So it would show us if the fixed asset turnover ratio is high, so it is showing that we are utilizing our fixed assets in a way that it is generating revenue. But if the total fixed assets ratio is less, then it is indicating that we are not effectively and efficiently utilizing our fixed assets against the revenue we are getting. So this is what we call as fixed assets turnover. Moving forward, the fourth type of ratio, which is liquidity ratio. So liquidity ratios basically are the financial metrics that helps us to determine a business ability to pay off its debts without raising external capital. So जितना भी company के ऊपर उधार है, the company is having certain debts which are to be payable for different stakeholders of the company. So it is basically an indicator that how much a company is capable of paying its debt without raising external capital. So ऐसा नहीं है कि एक उधार को चुकाने के लिए दूसरा उधार लेना पड़े. जैसे if you see a typical example, some people what they do, they swipe their credit card and then make heavy purchases, and in order to pay the bill of credit card, what they would do, they would took a personal loan, and then based on the personal loan, they will make the payment of the credit card. So this should not be done in a company's with the company's point of view. So liquidity ratio should be like in a way so that the company can just the uh, company can pay their debts without raising capital, external capital from the outsiders, like taking loans or something. It includes current ratio and the quick ratio. Just give me a minute. Just give me a minute. So yeah, sorry for this little interruption. So I am actually busy in something, so I'll try to finish this like real soon. We'll continue in the next lecture. So the current ratio helps to measure the ability to pay short-term debt obligations within the current period. So if a company has taken a quick loan like for one year or within the current period, one financial year, so it would come under the current ratio. Or like company has to some bills payable to them, or company need to pay interest or rent or something like this. So these are the current obligations which a company needs to pay within the stipulated time, typically a financial year. Okay, so current ratio helps us to measure the ability of the company, that how how much short-term debt a company can pay with its own resources within the current period. Moreover, it helps to know how a business can maximize its current assets even by paying its current debt and other payables. So this would also helps us to to understand or to make to maximize its a company's current assets after paying the current debts and other payables. So we have to keep these current assets a little more than our current debt and other payables. So the formula to calculate the current ratio is simple. This you all might be aware about. Current ratio is equals to current assets divided by current liabilities. So this would show us the current scenario, and this would helps us to understand whether we are capable of paying our own debt, which are or on debts in a stipulated time, typically a financial year or within a financial year. Okay, and after what are current ratio, this is the quick ratio. What is quick ratio? Quick ratio defines company's ability to meet its short-term debt obligations with its most liquid assets. Furthermore, a higher quick ratio determines better liquidity and financial health, whereas a lower quick ratio defines that the organization will have difficulties paying its debt. The formula to calculate the quick ratio is as follows. So quick ratio is basically confined with the word most liquid assets. What is the liquid assets? Liquid assets are the assets which can be converted into cash as and when required. Okay, so there are some certain accounts payable or the bills payable or bills receivable, sorry, and accounts receivable, which a company has, which a company will get after some time, but some are of that nature which cannot be redeemed like on as and when required. So they take some time to convert it into the most liquid, like into cash. So the formula for the quick ratio is equal to cash equivalents, cash or plus cash equivalents, which can be quickly converted into cash, plus inventory, plus accounts receivable, and we have to divide by the current liabilities, and we will get the quick ratio. Finally, this is the solvency ratio. The solvency ratio determines the ability to meet long-term debt obligations. So there are certain long-term debt obligations a company had. So this solvency ratio would help us to determine those long-term obligations, and a higher solvency ratio indicates an increased ability to cover its liabilities over a long period. So if the solvency ratio of a company is high, it means that company can cover its long-term liabilities. For example, there are some loan taken from the bank for 15 years. If the solvency ratio is good, so it would tell us that a company is in a position to repay its debt, long-term liability, on the specified time. But if the solvency ratio is less or lower than expected, then it shows that the company might fail to pay the long-term obligations by paying the loans they took before starting the business or something like this. I think the idea behind it, you are getting it. And since you are like very passive audience, so I just presume that you are getting what I am teaching to you. And solvency ratio would be calculated based on the debt to total assets ratio. That is the, in simple terms, udhar we had taken, and the total assets at the total assets of the company. So the debt to total assets ratio defines the total amount of debt relative to assets owned by the company. So इसके कंपैरिजन में डेट के कंपैरिजन में कितना हमारे पास एसेट्स मौजूद है. सो फॉर एग्जांपल, डेट हमारे पास 10 लाख का है और एसेट्स हमारे पास 20 लाख की है. सो आवर सॉल्वेंसी रेशियो वुड बी गुड. But if the things are like reverse, so the solvency ratio is not good. We have to take certain judicial decisions, or financial planning is required. Okay, so while calculating this ratio, all of the company's debt must be considered, including loans and bonds payable. This is what I was talking earlier. So what we have to do, we have to take into consideration all the debts owned by the company, any loan which a company has taken, or any bonds which is yet to which is payable after a certain period of time. So similarly, all assets must be considered, including intangible assets. Assets be aisa nahi hai we just keep only tangible assets. Intangible assets, I am pretty sure that you are you are aware of this term, intangible asset. This is quite simple. We have been reading it since class 11. So intangible assets are the assets which cannot be seen or touched simply, but they are there, like royalty or something like this. So the formula to calculate the debt to total assets ratio is as follows. This is simple formula. If you see it on your screens, debenture to total assets ratio is equals to total liabilities upon total assets, which helps to understand the solvency, how solvent our business is. And this would help us to this would help a business to become insolvent in the coming future. So if there are strong indication that our solvency ratio is not appropriate for the like 4 or 5 years, then the insolvency, the danger of insolvency can be in the eyes of the owner. So in order to keep our business running, and in order to keep our business out of the danger from becoming insolvent, we should strongly, or we should with our naked eye, we should have a bull's eyes on the solvency ratio of the company. Okay, so this is the theoretical aspect of it. And आगे कुछ slides हैं जिसमें I have shown it using Excel. But today I need to finish it a little early because I am at some other place and I have some other commitment. So I'll try to sum it up in the next session. Okay, thank you so much. If you have any question, just let me know. Otherwise, I'll just finish it here. Anything you want to say? Or should I end it? Say yes or no. Anyone? Hello. Is anyone here?
Yes.
Yes, sir.
Yes,
Okay,
sir.
okay. So I'll just finish it up. Okay, and see you on the next session. Thank you so much.
Thank you, sir.
Thank you.